Now, if there was one thing which has actually dented India's image in terms of an unstable tax jurisdiction was the indirect transfer of share case in the case of Vodafone. It's been some time since things went bad. They had been continuing for a long period of time, but finally we've seen that there is a ray of hope because the proposals that have been made in the current budget are good enough to kind of lay away the fears of the investor that we are not a stable tax jurisdiction. So effectively what happened in this case was there was a foreign company 1, foreign company 2. Okay, there was a sale of shares of the foreign company 2 by foreign company 1. And the foreign company 2 basically owned Indian company, which is the ICO in this case. The issue was whether the value or whether the transfer of shares of FCO 2 was taxable in India. Okay, and if so, when? So the law which was amended in India in 2012 provided that the value of FCO 2, if it is derived substantially from ICO or any other Indian company, then basically the transfer of shares of FCO 2 by FCO 1 will be taxable in India. So taxable if substantial value of FCO 2, which is this company, derived from India. But the law did not define what was the meaning of substantial, and therefore the fear of the investors on how this will be treated by the tax office. Now, what are the clarifications that have come in the budget? The clarifications are that the value shall be deemed to be substantially derived from India of a foreign company if the value of the Indian assets is greater than 10 crores and this "and" is missing over here, and greater than 50% of value of all assets owned by the company. So the value of the Indian assets should be greater than 50% of the value of all the assets owned by the company. So if FCO 2 owns Indian assets greater than 10 crores plus the value of FCO 2, if let's say it's 100, is 60 from India, which is greater than 50%, then the transfer of shares of FCO 2 by FCO 1 will be taxable in India. And how do you calculate the value of the assets? The value of the assets is to be considered as the fair value of the assets. Even if there is any liability that you have taken against that asset, that is to be ignored. Now, this is also important. How this will pan out is something which we'll need to watch out for. The value of the assets is to be calculated on the last accounting period end date. So if let's say, for example, they follow a March year end, then it is to be taken on 31st March. Unless the book value on transfer date is greater than book value on the accounting end date by 15%. So if let's say on 31st March the value is 100, you sell it on 30th June, and on this date the book value is, let's say for example, 120, which is more than this value by 15%, then the 120 value is to be taken. But if it is, let's say for example, 110, which is not an increase of 15%, then 100 is to be considered. There will be detailed rules which will be specified how to calculate the fair value of the Indian versus global asset. The next thing is that these taxation are going to be on a proportional basis. Okay, so the taxation of the transfer of shares, whatever gains are arising, only the proportional amount will be taxable in India and not the entire amount. Let's look at another case on indirect transfer of shares. Okay. In this case, there are two things which we are looking right now. Let's first look at the first one. Okay, look at it up to this level. So the exemption which is available to FCO 1 on transfer of shares of FCO 2, which is directly owning shares in the Indian company, shall be available when the control, management or voting in the Indian holding entity, which is the holding of the entity itself, which is FCO 2, plus its associated enterprise, is as such that they do not have a right of control or management of FCO 2. And there is no voting power or shareholding which is less than 5%. So they have to have a voting power shareholding of less than 5%. Similarly, in case the transfer is not of the shares of the company owning the Indian asset directly, but of the company above that company. Okay, so let's say if FCO 1 owns shares of FCO 2, if EXCO transfers the shares of FCO 1, then this will be also exempt provided the transfer of shares of foreign company not owning Indian entity, which is FCO 1. It is not owning the Indian company directly, but it is owning it indirectly, is exempt where the shareholder entity here refers to EXCO plus the associated enterprise in the entity owning direct shares, no control, right of management, voting power, shareholding less than 5%. Now it will need to be seen what is implied by all this. I mean, these cannot be a standalone condition which can apply to the indirect transfer of shares. In effect, what this may mean is that once this foreign company too is actually having substantial value from India, if there is another foreign company which is having a minority stake in this company, then how that taxation work, but obviously we'll need to wait for the rules to come in to clarify on this aspect.